Okay, everybody, we're getting ready for our live lesson today on Thursday. This is Atlantic International University. My name is Dr. Lambert, and our guest speaker today is going to be Gino D Alessio.
That's correct.
And you're going to be talking about, well, give us a little bit about your background and what you're going to be talking about.
Sure. I have a 20-year plus experience in the financial markets as a broker-dealer, mainly over-the-counter markets, including Forex, government bonds, and various types of derivatives, mainly interest rate swaps. And I've done some personal training, some retail training, trading, and I've spoken to a lot of traders, and I've learned and studied a lot of the aspects of trading, and basically the things that you need to know. So what we're going to be talking about is how to get started in the financial markets, let's say, as a trader, as a retail trader.
Now, do you plan to do a series of sessions talking with the students on different topics?
Yeah, as we've just started the first class, this is my first class in English. I did one class before this in Spanish, and we actually never managed to get through the presentation that I have in front of me. I'm guessing it will probably take a couple of classes to do the presentation. Basically, we're going to go through the basic terminology of the financial markets and trading, the types of instruments, and then get into a bit of detail on aspects such as leverage or automated trading, as in expert advisors are often called, the use of risk management. We'll touch slightly on trading psychology, and then some simple things that we need to know about the fundamentals when you're trading the financial markets, macro fundamentals, and obviously when you're trading stocks, things get more complicated because each company has its own particular universe. In fact, most of the trading I've done has been in macro markets, meaning markets that the fundamental drivers are macroeconomics rather than intrinsic fundamentals to a particular company. So we'll be touching on that as well. And
now, is your goal to train people to be professionals in marketing and trading, or not really, or just how you could do this on your own?
Yeah, this presentation is really just about how to get into trading the financial markets from the point of view of a retail trader. Basically some simple things you really need to know before you start, because statistics show that most retail traders, and a very high percentage, like 80% of retail traders, lose money, and there are probably various reasons for that, and we'll discuss, through the presentation, we'll discuss what we need to know before we get started to try and decrease the chances of losing money. So I don't know, whenever you guys are ready, I'll start.
We are ready to go. Is everybody ready to go? Yes. Got some waves, hands up, ready to go.
Okay, so basically I'm going to talk a little bit about trading the financial markets from a retail trader's point of view. And the thing is, trading the financial markets has become very popular. A lot of people are taking this activity up as maybe a part-time activity to earn a bit of extra on the side, and some actually manage to make it a full-time occupation. Few things we need to know before we actually sort of get into the presentation. A couple of things you need to know about the financial markets is a bit of jargon. Things like bid and offer. The bid is the price where you're willing to buy an asset. The offer is the price where you're willing to sell an asset. There are a couple of other things like being long or being short. When you're long an asset, you've bought that asset. So if the price goes up, you make money. If it goes down, you lose money. And the opposite to that is being short of an asset. So if you're short of an asset, you've sold that asset. If the price goes down, you make money. If it goes up, you lose. Some particular things to pay attention to when you're looking at the financial market, and before you get into it, things you have to understand is volatility, margin, and leverage. Volatility is the rate of change of the price of an asset, how quickly it goes up or down within 5 minutes, 10 minutes, an hour, a day, on average. To show a bit of what volatility means, I'll share my screen. And we'll get to see here. This is a chart with the price of sterling pound versus the dollar, often known as cable. And these are 1 hour candles. So you can see there's quite a bit of volatility. If you look at the 5-minute chart as well, you'll see that the price tends to change, go up and then come back down and then go back up again. So this change in price of going up and going down is what is known as volatility. And volatility is measured in terms of a percentage. So a very volatile market, like some stocks may be very volatile, especially when they have a small capitalization in the market. They tend to be very volatile. Maybe they change 10% in one day. The price might change 10% in one day. Whereas the foreign exchange market.
What is capitalization?
Capitalization of a stock is the number of shares multiplied by the price of that share, of those shares of the quoted company. So a company with a high capitalization, for example, Apple, which has millions of shares, and they're quoted around $100 and something a share, and it's worth billions of dollars, meaning the total value of all the shares quoted in the market. That's the capitalization. In the case of Apple, it's hundreds of billions. In the case of smaller companies, it might be a few hundred million, in which case it's very easy for one big trader or big player to change the price of that stock with just a few $1 million worth of stocks. And that's where we see volatility come into play, usually when a market is very small, such as a stock market of a small company. Whereas a foreign exchange market, which is the largest market in the world of any asset, the largest currencies, the most traded currencies like sterling, euro, and yen, have a very, very large amount of money traded every day. And therefore the volatility is very low. Example, typical volatility of euro dollar or sterling dollar is around 1% a day. Whereas other markets like crude oil might change 3 or 4 or 5% a day. Just to sort of explain the concept of volatility. For some assets are more volatile, they change in price more rapidly. Other assets are less volatile, they don't change in price so quickly. And then next one is margin. Margin is the amount of money you put on a trading account to use as trading capital. So let's say you put $10,000 on a trading account. That will allow you to trade in financial markets with, depending on what markets you're trading in, a higher dollar amount than the actual amount you have on your margin account, right? This difference between the actual amount you have on your trading account, which might be $10,000, and the possibility of trading for, let's say, $30,000 or $40,000 or $50,000, that difference is called leverage. And leverage is basically the concept of using a smaller amount of money to guarantee the performance of your trade. So, for example, in foreign exchange, it's very, very common to see leverage of 20 to 1. 20 to 1 means you can trade 20 times the amount you have on margin. So if you have a margin of $10,000 and you want to trade in Forex, you could quite possibly find, most brokers allow this, you could possibly find you're going to be able to trade with $200,000. So you'll be able to open a position of $200,000. This is allowed because the gains and losses are guaranteed by the $10,000 you have on your account. So if you're trading dollar yen and you open a position of $200,000 and the market goes up 1%, you're making $2,000. If it goes down 1%, you're losing $2,000. So your possibility of losing is pretty much covered by the amount of money you have on the margin. Obviously, the greater the leverage, the riskier your trade is going to be. And this is another factor that often traders that are just starting to look at the financial markets, they see a lot of brokers advertise 100 to 1 leverage or 200 to 1 leverage. And that looks very appealing because you can trade in larger sizes. So if the market goes in your direction, you're going to make a lot more money. But if it goes against you, you're also going to lose a lot more money. So for example, if we take a trade for $200,000 and we have a $10,000 margin, the trade unfortunately goes against us. It goes against us by 5%. That's $10,000. Sorry, that's $5,000. 5%. No, sorry, that's $10,000. Yeah. So we would wipe out our account, our trading account, if the trade went against us. Obviously, 5%, depending on the markets, is a lot. You know, it's likely not to happen. Well, what I'm trying to point out is that the higher the leverage, the higher the risk, and the higher the risk of burning your account in 1 or 2 trades. So it's very important to measure leverage correctly according to the volatility of a market. If foreign exchange market, for example, has a 1% volatility, if daily volatility, if you're trading with leverage and you're trading 20 to 1 leverage, you have to multiply that volatility by 20. So your change in profit and loss can be multiplied by 20, meaning you could lose or gain 20% in one trade if you're using a leverage of 20 to 1. If that makes sense. Does that make sense, what I just said? Let me hear from somebody if I manage to explain that clearly.
Is there a formula that you can use for that?
Yeah, there is. Right. Let me just open up
because I could write the formula into chat.
yeah, let me just show you my screen again.
Oh, okay, good. What I did when I started to learn trading is I got out the Wall Street Journal. I was concentrating on soybean futures. So I studied soybean futures for 2 years, having a notebook where I would cut out news articles and the prices. For 2 years. I would keep this notebook of how the price would change and the news that would affect the price. And so I would have this ongoing record of everything that was happening.
Right.
And then after about 2 years, then I felt comfortable to actually put money into the soybean futures market.
Yeah. Yeah, it takes a lot of time, it takes a lot of practice, and it takes a lot of discipline and a lot of dedication. It's it's a steep learning curve, as we often say.
So ROE, return on
Right, so the return on investment, which is your investment is the 10,000 of margin you have on capital on your margin account, on your trading account, is equal to the return on the investment. Yeah, so let's multiply it by the leverage. So let's say your investment was in a $200,000 trade and you lost 1%. 1% of 200,000 is $2,000. Yeah, and you have to multiply it by your leverage, by the leverage here, which is 20 to 1. So you have to multiply it by 20. And we can see that that equals $40,000. Right, yeah, $40,000.
So basically with that, if you invest on 20 to 1 and you put in, so you're buying $200,000 worth for $2,000.
Yeah, you're buying, let's say you put on a trade of $200,000. Yeah, the market moves by 1%, and that is equal to $2,000, right? So if you put a trade on for $200,000 and the market moves 1%, obviously if it goes against you, sorry, I'm getting myself confused now. That's a percentage. So this is 1%. Sorry, I'm getting confused here. The thing about not being a good teacher, I'm sure Dr. Lambert can understand me.
I do. You work with these things so quickly.
Yeah.
You work with these things so quickly in your mind when you're trading, you don't think about the formula.
What you're doing. So, right. So the return on investment, the return on equity. Let's get back to what I was trying to say. The return on equity, yeah, is equal to the return on investment multiplied by the leverage. So the return on the investment, which was 1%, multiplied by the leverage, which is 20, gives a return on your equity, on your margin of 20%. Now the margin was originally $10,000. So we made or we lost $2,000. So the return on the equity was actually 20%. And what does this show? That the leverage will make you gain more money if you get it right, but will also make you lose more money if you get it wrong. So because we started with a $10,000 account, a 1% change, 1% change in the market represents 20% change on margin. So,
A return on investment is 20%.
Yeah. So the return on the equity.
On
the equity. The equity is no word for the margin. The actual amount you have on your margin account, on your trading account, which was 10,000. Now, if you take a position of 20,000 and the market moves 1%, then that equals a difference for you of 20%.
So basically, return on investment is the 200,000. Return on equity is the 10,000.
That's right. Equity is what you actually put up to trade. also known as margin. And the investment is what you actually traded with, which is 200,000. And then clearly what I'm trying to point out here is that the higher the leverage, the higher the change on your margin. Yeah. So if we use 40-to-1 leverage, and there are plenty of brokers that will offer 40-to-1 and even higher, all this changes, all this becomes 40%. Yeah. But your dollar amount, 40% of 10,000 is $4,000. So if we were using 40-to-1 leverage and the market goes against you by 1%, you're now losing $4,000. But we can see how using excessive leverage can be very, very dangerous. It can be great if you get it right, but because markets are very volatile, they tend to go up as well as down. I would be very cautious about how much leverage you actually apply in when you're actually trading. A fact of note, which is sort of going to tell us what kind of leverage probably works best. Hedge funds. Hedge funds are big risk takers, and we all know what hedge funds are involved in, right? And basically, it's very rare that a hedge fund will trade with higher than 5-to-1 leverage. Some hedge funds are trading Forex only. Perhaps they have 10-to-1 leverage. But most hedge funds will only use 5-to-1 leverage.
So Forex is the foreign exchange markets where you're dealing in currencies.
Yeah, Forex is a foreign exchange market, yeah. And did I see a hand up somewhere? No.
There was a hand up there for a second.
I missed it.
Solano, did you want to raise your hand again? I think we can hear you now.
Okay. Thank you. I know this is something for people who are trading shares and so forth. I'm always asking people about these shares, but it is quite interesting to find out that when you have your investments in this type of markets, you have to be patient, be working with a very long or high horizon. It's not like you can wait for your money for 10 investment returns for 10 years and it's enough. It looks like it's very, very long term, 25 years or 50 years. So what I want to know is this what you can prefer to use if you are saving for a child's education right from birth, so that you can say, okay, when you go to college at the age of 18, you'll be sure of having invested in this markets, especially the shares, whatever it's called. Will that be the right thing to do, or just hoping that it go up and down, and by the time the child turns 18, things will be all right? Thank you.
Yeah, I think so. If I've understood correctly, I think there's something I should differentiate between trading and investing. So I think what you're talking about is investing, and investing is definitely a long-term horizon. And you're not so much interested in market timing, which means buying the asset just before it goes up or selling the asset just before it goes down, because you're looking for a long-term investment. You're looking to buy shares, or preferably funds which invest in many, many shares, and that way sort of you have the effect of risk diversification. So yeah, with investing, it's about the long term. And in fact, if I'm going to show you the
Like, if I could just,
standing
well,
poor's,
say here,
I'm going to show you the
like right now with the Ukrainian war,
yeah.
the source of natural gas to Germany is being cut. And who's the second producer of natural gas in the world? Nigeria. But Nigeria is going to have 5 to 10 years to build that infrastructure to serve Germany with natural gas. So
Right.
if you're going to invest in the natural gas from Nigeria to go to Germany, you're going to be in there long term, waiting for those profits to come. Was that a good way to look at it, Gino?
That's a good way to look at these things, yeah. But again, because you're specifying a particular possibility, it's always good to diversify your portfolio. It's the best practice you can have when investing, because diversifying your portfolio diversifies your risks. Because investors are not looking to pick the winning horse, but let's say they're looking to pick a winning race, like a bunch of horses that make it to the finish line, rather than you know, putting all your money on one horse and it doesn't even make it to the finish line. But it's better to spread your investments around as much as possible, and for that, probably the best thing is funds. But obviously, you can also find funds in very particular markets. Like, you might even be able to find one that deals with something like natural gas in Europe. Lithium is a big commodity that's becoming very popular now, thanks to electric cars and other renewable energy requirements. There are funds that invest just in lithium based companies that operate or deal or trade with lithium or mine lithium. So, you know, that's an opportunity there, but always within a well-diversified portfolio. I'm just going to share my screen here so I can better clarify what we're talking about when we're talking about investing and investing being for the long term. So this is the chart of the Standard & Poor's 500. And well, this chart only goes back to 1997 approximately, but we can see that, you know, it goes up, it goes down, goes back up again, goes back down again. This was the crash in 2007, and it took almost 50% out of the market, but it still went back up again. Took its time, took just over 10 years to get back up. No, actually less. 2007. It was back up by 2013. It took just over 6 years to get back up above its previous high. So what I'm trying to say is that investing for the long term and diversifying the portfolio, I believe, is always a good strategy when it comes to saving for the future, saving for your kids' tuition or saving for your retirement. Eventually, you know, the markets always tend to perform positively, especially in markets like Germany and the US, which have very efficient economies and very efficient stock markets, and they just simply tend to increase over time. Okay, I hope that answered your question. Okay, let me just stop sharing that. Okay. Right, so I've got something here, something in the chat. Okay, greetings, Abdul. Just wrote in the chat there. Okay, so another thing that's necessary to to talk about when we're looking at trading the financial markets is a proper use of risk management and maintaining discipline. And it all starts with the volatility of the market you're going to be trading in and the leverage you're going to be using. Because if a market has a tendency to change price 10% a day, and you're using a leverage of 10 to 1, that means that you would quite possibly lose all of your capital in one day. Yeah, I believe that makes. Let me share my screen again. So let's say we're using we're looking at a market that has an average volatility or average change in price of 10%, and we're using 10 to 1 leverage. The change in my capital will be 100%. Yeah, does that make sense? If I have $10,000 and I put on a trade for $100,000, yeah, that 1%, sorry, 10%, and there's a 10% change. That 10%, yeah, so I use 10,000. I open an account for trading with $10,000. I'm looking at a market that has a 10% volatility, yeah, 10% average change in market price. So I open a trade with 10 to 1 leverage, and the market moves against me 10%. That equals $10,000, i.e., it's wiped out my account in one trade. So risk management all starts with the volatility of the market, which was this number. And according to the volatility of the market, then we understand how much leverage we want to take. Yeah. As I mentioned before, the forex markets tend to have a very low volatility compared to others, around 1% for the main currency pairs such as euro dollar or sterling dollar. So it's very inviting to take on a lot of leverage. 10 to 1 or 20 to 1 is very, very common. So in those markets, it might be sustainable to take on leverage of 10 to 1. Because I would be trading with $100,000. The market moves against me that day and I lose 1%. Well, I lost $1,000. I lost 10% of my account. That hurts, but maybe depending on your psychology, depending on how often you want to trade, it can be sustainable to put on trades like that. But from experience, I would find that using a lower leverage and putting on the trades you want to put on with lower leverage will probably make you last longer and probably have better results, because let's face it, when you're putting on a trade and your trade's losing $1,000 and your initial capital was 10,000, that doesn't feel good. Doesn't feel good to anyone. So I think it's necessary to scale the leverage accordingly to our personal risk tolerance and the number of times we want to trade. For example, if we're thinking of trading 4 or 5 times a day, how much money are we willing to risk per day? So if you start with a $10,000 account, I would believe not risking more than 5% of your capital is good risk management. Yeah, because if you've got $10,000 and you don't risk more than 5% a day, you've got 20 days to get it wrong, and that's kind of difficult to get it wrong 20 days in a row. Yeah,
I'm gonna stand here and say there's a difference between trading and then investing in the sense that, let's say you have a friend that has a business and you want to invest money in your friend's business. Well, if that friend needs $10,000, you can't margin in at $1,000 or $2,000 to invest. You got to give your friend $10,000. You got to give the whole amount to your friend. Now, what Gino D Alessio is talking about here is the markets for trading, where you're margining into these markets. These are structured markets where traders can actually margin into. So you're not giving everything, all the money that a certain business needs for retooling, expanding business or whatever, you're margining in a certain amount of money, and it may not make sense. You wonder, is that business receiving all of the money they need if people are just margining in percentages of that amount? How would you explain that, Gino?
Yeah, that's a good, that's an interesting way of looking at it. Yeah, because in the case of the friend, he absolutely needs the $10,000. If not, his project doesn't work, or his project will fail, or it simply can't take off. So whereas the financial markets is indeed margined, and the financial markets operate independently of how much money a trader has to put into the market or not. Basically, because they're so large, and there's nobody that can singularly manipulate the largest financial markets like the New York Stock Exchange or the London Stock Exchange, or excuse me, or the foreign exchange market.
So people are basically investing or trading into the volatility, those changes in volatility.
That's correct. So what you're looking to do is pick up on the change in price, the volatility of a market. So if it goes up 0.5%, and you bought the euro dollar and it goes up 0.5%, that's where you're looking to sell it once it's gone up 0.5%. And that 0.5% doesn't look a lot, but because you're using margin, you're probably using 10-to-1 margin, that works out to be 5% of your capital. So if you started your trading account with $10,000 and you made 0.5% on $100,000, you've made $500. That's a nice trade. It's very important to sort of give everything the correct dimension, because a lot of brokers online offer leverages which are extremely high, and they look very, very attractive, but they will often burn your account. And I've always wondered, I mean, I can't prove it, but I've always wondered if many of these brokers simply take the other side of the trade, and they don't pass on the trade to the market, knowing that 70-80% of traders lose money. So basically they keep the money you lose because they haven't hedged your trade with a market maker. They haven't sent your trade to the market. But obviously you can't really see if your trade went to the market. You get a confirmation from your broker that says you traded. And if you bought euro dollar and it goes up, they'll pay you to your account. And if it goes down, they'll subtract from your account. But I often wonder if they actually do send the trades to the market when they know that between 70 and 80% of traders fail. So, you know, that sort of puts things into perspective. You know, these brokers are selling you 40, 50 to 1 leverage, but I really recommend not taking it and not using more than between 10 and 20 to 1 leverage to keep things in a certain, in a manageable dimension. You know? So as I was saying before, if you're looking to trade every day and you've got a $10,000 account, how much are you willing to risk every day? That's an important question, because as I said before, if you risk 0.5%, well, you've got 20 days to get it wrong before you deplete your account, before you've run out of money. It's very hard to get it wrong 20 days in a row. So it's about managing the risk on a daily basis and managing the risk per trade. So once you've got your risk per day, so let's say that risk is $500, then you want to say how many trades am I going to put on at the same time? If I'm going to put on 1 trade, then I can risk the whole $500 because that's my daily limit. If I want to put on 2 trades at the same time, then I have to split that risk between the 2 trades. There would be no point in putting on 2 trades with each $500 of risk, because if they both go wrong, now I've lost $1,000, and that's 1%. Or sorry, 10%, not 5%. So I need to stay focused more on risk management and And it's a very important part of trading, which often retail traders will overlook. And and that brings me to the trading psychology. And trading psychology, what I found personally, and I'm sure it happens to a lot of retail traders, is that there is a ludopathic element to trading. And what I mean by that is that retail traders will often feel like they are making a bet. A bit like when you bet on your football team or you bet on horse races and you really believe this is going to be the winner and you put your money in the bet. But trading is not about betting. You have to get rid of that ludopathic side of trading. Trading happens because firstly, you have a trading plan, and then you apply the trading plan. And if your trading plan works, then you'll make money. And if it didn't work, then on that occasion, you'll lose money. So it's important. It's important to have the right psychology when you're picking up trading, and to understand that you're actually in a business and not in a gambling activity. Trading is not the same as gambling. It might look like it to some people, but when you're trading, you're making informed decisions about a market or an asset, and based upon the information you have, you take a position, either long or short, and obviously, hopefully it goes up. Now, something I mentioned just now is the trading plan. And that's a very complex subject because we're each different. Godwin says he's not hearing. Everybody else hearing me? Can everybody hear me? Yeah, okay. All right. Godwin, I'm not sure what it is. And so what we have to set up the trading plan, there are a couple of things you have to keep in mind. First, your psychology, in the sense as what type of trader you are. So some traders are big risk takers, and they love to use large amounts and trade for very small percentage losses or profits. So for example, if somebody who's a big risk taker and likes to use 20-to-1 leverage, or 30 or 40 or 50-to-1 leverage, will trade with very large amounts, but for very small changes in price, meaning the price only has to go up very little, maybe 0.1% or 0.2%, because he's using 50-to-1 leverage. That's enough profit for him. Now, other traders want to use smaller sizes in their trades, let the trade run for longer periods of time, maybe hours or days or even weeks, and then take their profit or their loss. And that's possibly the main factor to determine is what type of trader you're going to be. Are you going to be a short-term 5-minute, 10-minute, 20-minute trader, or are you looking to trade big moves, maybe 0.5%, 1%, 2% moves that are much more sustained in time? And you can see from the screen, I'm just showing my screen again. And for example, if you're looking to trade on a market like this one, this is an index, Standard & Poor's index of New York Stock Exchange. So you might be looking to trade small amounts, but take the trade and make it last for various days. For example, here, there was a break of this resistance, this blue line, which was a resistance line. There's a break on this day here, which was on 10th of January. The trader might have thought, okay, I'll buy some Standard & Poor's index, I'll buy it here. After 2 or 3 days, it's gone up, but not quite enough. It comes back down again, doesn't close the position because he's looking for a longer return on his trade. Eventually, he'll close it somewhere up here as it keeps going up. And this trade has lasted about 4 weeks. Yeah, so that's one type of trading. It's called swing trading. As you put on trades for smaller amounts, but they last a lot longer in time and have a very large percentage-wise change in price. And then there's,
Gino, I'm gonna ask you to do something here. Are you able to bring up the currency of Nigeria, for example, or another African country?
Yeah, let's have a look at that. One sec. No, I don't have Nigerian dollar. Let's have a look. Just have a look. Doesn't look like.
You have the
Euro.
euro, British pound,
They have
US dollar.
dollar.
Go ahead and bring up against the
Dollar?
British pound or the euro or the US dollar.
I don't see against the US dollar. That's strange.
Yeah, the US dollar, I see.
Oh yeah, there it is. There it is. Oh wow.
So
That is volatile. That is a volatile market. This is the weekly chart, and look how much it's moved.
now when you look at this, what would be your strategy to protect yourself against changes in your own currency, for example?
Well, it's very easy here. You've got no choice but sell Nigerian naira, sell the naira, and buy the dollar. And
Would you continue to do that? How would you know if it's bottoming out?
You don't yet. You don't yet. And the only way you would know is if all of a sudden it makes a big shot upwards. And because it hasn't done that for like a long time. Okay, well, it hasn't done it since 2014, which is what I have in the chart. So because it hasn't done that for such a long time, you would have to presume that this rate is going to stay here for some time, like it did previously. It might go up a little bit. It went up over here a little bit. But eventually it's going to come back down again. It stayed around here for a while, it came back down again, and it seems to have done it various times. So if you want to protect yourself against falls in the naira, yeah, one way to do it is open a brokerage account and sell some naira against the US dollar.
Well, if the US Federal Reserve comes out and says, okay, we're not going to start raising rates as much as before, that will cause the naira in Nigeria to go up in value, right?
Yeah, in theory. That's kind of in theory. And I'll tell you why. I don't follow the naira much, but I follow the dollar a lot. At the end of 21, 20, where is it? 20. Okay, here in February 20, in March 20, the Federal Reserve in the United States had to put interest rates down again because of the pandemic, and started a new quantitative easing plan. So You would have expected perhaps the Naira, which I believe Nigeria was not as heavily affected by the pandemic as Western countries were. You would have expected the Naira to go back up again, and it didn't, continue going down. Probably due to the pandemic, I guess, or fears of the pandemic or whatever. But what I'm trying to say is that I don't think
It could have been because of the price of oil, since Nigeria produces so much oil.
Yeah, this is
And the
also,
consumption of oil decreased severely during that time.
yeah, that's possible. That's
And I
possible.
think most of the Nigerian Naira is traded around oil production and oil sales.
But then when oil went up in 2022, which is around here, February 22, or crude oil went up a lot and it lasted most of 2022. There was no change in the price of Naira.
Right. So understanding why that happened is crucial to understanding how it's going to come back up, right?
Yeah, from what it looks like, from just technically looking at it, the charts, it doesn't look like it's coming up anytime soon. This probably, this sideways trend is probably going to continue until it breaks it on the downside, most likely towards the downside. Or it could happen that it goes back up again, but there's no indication it will. Yeah.
Do you see any strategy as to try and figure out when it's going to start heading back up?
Yeah, the only strategy that would really tell me it's heading back up is perhaps on the day chart. But right. Yeah. The only strategy I would see is basically on the weekly chart. If on the weekly chart, this makes a big break in 1 week, so there's one big long candle, yeah, in 1 week, then maybe that's the beginning of a new bull market for the Naira. And then the subsequent weeks would have to trade past this cloud. This is the Ichimoku cloud, which represents a strong resistance. As we're in a bear market and prices are below the cloud represents a resistance area. So we would need two things: a breakout to the upside with one big long candle, meaning 1 week, a strong move upwards of a Naira. And then the subsequent weeks, it would have to remain around this area and eventually trade above this cloud, above this price here.
When we look at your chart there, it never broke through that cloud.
No, it never did. No.
So in this, if you were to invest right now, you'd say the best bet would be to sell short because you think it's going to be going down in value.
That's right. Yeah. Yeah, definitely. If I were a trader trading Naira dollar, I would certainly not buy this. I would definitely sell it. If anything, I would sell Naira. On top of it, the moves happen very quickly.
And would you do this on a daily basis or a weekly basis?
Probably on a long-term horizon. You know, I would sell it and hold and wait for the next drop to happen. Yeah, I would wait for the next drop to happen. This happened in 1 week. There must have been some intervention of some kind, maybe by the Nigerian central bank, or I'm not sure, and send the market down. But this drop happened over several weeks. So presumably the next drop will happen over several weeks as well. This one happened over several weeks in the data. So this is interesting. It stayed in the same area for almost 2 years. So from 2018.
Now, do you study the reasons behind the price, or do you basically study the technical trends in the graphs?
No, here I just studied the trend in the graph because I don't have enough information about Nigeria fundamentals. When I look at charts for, let's say, euro dollar or sterling dollar, then yeah, I do look at the fundamentals as well. They're easily accessible, and those are the markets I follow. So you have to look at the fundamentals when you follow a market. That's another thing I wanted to discuss very quickly. When you're looking at trading, it's very important to use graphs like this, like charts like this one, and they give you an idea of where you should be, what you should be aiming for, what you should be looking for. Okay, and this is a 4-hour chart of Standard & Poor's, and it's sort of very choppy at the moment. We're at a very clear tendency. We're at a very clear trend. But apart from the technical side, you also have to look at some fundamental data. And the main fundamental data are unemployment, inflation, gross domestic product, and the Federal Reserve Open Market Committee press conferences that give us clear information, forward guidance, they call it. And it's when the Federal Reserve Chairman talks about the policy of the Federal Reserve going forward in the next few months. And all these things are important because they tell us how strong the currency is, or how strong the stock market is. Obviously, low unemployment or high employment, low inflation, a very high gross domestic product would be very good for the stock market, and would mean it's likely to continue a rally if it's in one. Whereas in currency pairs, if one country is doing particularly well in gross domestic product and it's rising fast, and the other currency in the pair is has a gross domestic product but is declining, then obviously the currency with a strong domestic product should appreciate compared to the other currency. A couple of questions here. Abdul is asking, is there any formula to calculate risk involved in trading? Well, yeah, in a way, but we wouldn't be able to cover it here. But I'm going to put my Excel sheet on, and I'll just share with you how you can calculate risk.
Yeah, when you get into the mathematics of trading, it gets very deep.
Can get very complicated, yeah.
So when I'm looking at this graph that you have up on the screen, I'm looking at that cloud, and I can see that back in March 6th or so, it broke through the cloud, but then started back down again.
Yeah, let me go back again 1 second. All right, I didn't realize that we're looking at it.
So you would think, okay, it's breaking through the cloud. Let's go ahead and trade it. Let's go ahead and buy it. See now over there on March 6th?
Yeah, around here, right?
No, a little bit farther back. That's like March 17th. Keep going farther back. Right about a little more. Right about there. See how it broke through the cloud? There must have been a lot of people that started to buy the market, right?
Yeah, there might have been, but if I'm trading this, I wouldn't put on this trade. Excuse me, for a very simple reason. This lagging line, I don't know if you guys can see this green line.
Yes, we can see that.
Here?
Yes.
Right, that's called the lagging line. If the lagging line doesn't break above the cloud as well, you haven't got a buy signal. Right? For the market to be in a bull market, the candles have to close above the cloud, but so too does this line here. It doesn't actually happen. So a trader watching the Ichimoku cloud wouldn't probably put that trade on. It does happen here. In this candle, we get a breakout. Yeah. And it looked like yeah, we've got this breakout here. You see the lagging line breaks out, the candles are above the cloud. But then on March the 22nd, there was a Federal Reserve Open Market Committee meeting. And what came from that meeting was basically the interest rates were going to go up, possibly for longer than planned. right? So the stock market didn't like that announcement. And of course, it fell back down again. But it fell back down again, went back up again, it fell back down, but it never actually broke through the cloud again on the downside. The Ichimoku cloud maintained its validity, and all the candles stayed above the cloud, and then it has since gone back up. Yeah.
So you look at this and you think, okay, we're in a bull market.
Yeah, we are in a bull market, at least on the 4-hour chart, because the day chart gives us another.
In the research I do in economics, when people like 6 months ago were starting to talk about, oh, there's a recession coming, I looked at my data and I went like, no, there's no recession starting soon.
Right.
And so you still see these signs in the market that there's a bull market.
Yeah.
And now people are talking again, oh, it looks like we're going back into a recession.
Yeah, well, if inflation lasts long enough, maybe. And I know you're more of an economics expert as well, but I only know what the market fears, and the market fears inflation. So if inflation keeps going higher, it doesn't look like it is. It looks like it's stabilizing.
Yeah.
But if inflation were to go higher and continue higher, maybe we would see this come back down again. Notice that it hasn't managed to break the cloud yet. This is the day chart, right? So on the day chart, which is possibly more important than the 4-hour chart, the day chart shows that the market is not in a full bull mode, not just yet, because it hasn't broken the cloud around here.
So you would then conclude that it's going to probably just stay stable, going horizontal sideways for a while.
It could stay sideways for a while, yeah. And the most likely thing here is if it doesn't manage to break it tomorrow. Tomorrow we have PCE data, right? We have some inflation data.
Yes.
If that inflation is really, really good, I mean, that data is really good and it's really low, maybe this breaks tomorrow, in which case the bull trend is confirmed for the day chart. If it's higher than expected, then maybe it comes back down again into this range here, and it stays around here for a few days.
So if let's say a person is in Nigeria and they see their currency going down,
yeah,
do they try and counteract that by getting into the currency markets, or should they be looking for opportunities for investment in other parts of the market?
Well, they can look for opportunity or investment in other parts of the market. For example, buying stocks denominated in dollars would certainly help. For example, if they have a company or companies that they feel the stocks are likely to go up over the next year or two, they could buy those stocks. And because they're denominated in dollars, what they're actually doing is selling the Naira to buy the dollars with which they then buy the stocks, right?
Right.
So you'd be short of Naira and long of dollars, and at the same time hold an asset, which is a stock in this case, or a bunch of stocks that may go up in price. So they would get possibly two benefits. If the Naira falls again, they've got nothing to worry about because their money's invested in dollars. Yeah, so their investment will appreciate in Naira terms, and they also have the possibility of a stock price going up.
So instead of losing money, you're protecting your money, but also giving you the chance of making money.
Yeah, giving yourself a chance of making money in two ways: by the stock price going up, which if you hold the stocks long enough, they probably will. And yeah, you have the possibility of protecting it, of making money if Naira goes down again, which it looks like it will continue.
So then if you sell that investment, you'll get back a lot more Naira than you started with, and then you can then buy again into the market, and you can upgrade.
That's right. Yes, correct. So let's say the stock price goes up and Naira falls and you've made some money. You can say, okay, well, this particular stock or this group of stocks, I think they're not going to continue increasing in price over the near future. I can sell those and cash in on that money and use that extra money to buy some other stocks, or you can cash in on those stocks. You take the money you've earned on those stocks and then sell the dollars to buy Naira, and obviously you'll buy them at a profit. You buy the Naira at a profit.
So if you sell an investment using US dollars, should you not trade it back into Naira? Just keep it in US dollars and keep reinvesting it?
Yeah, it depends what your outlook for the Naira would be. If you believe Naira will continue to fall and you don't want the money, you don't want to cash in on the money just yet, then yeah, you probably want to reinvest in other stocks. Whereas if you want the money for whatever reasons, or you believe that Naira will not be going down anymore, then maybe it's time to exchange your dollars for Naira.
But that gives you a strategy for protecting yourself. At least you can do something.
Sorry, I missed that part.
Oh, so at least you have a strategy to protect yourself.
Yeah, that's correct, indeed. I just wanted to say thank you to Constance. Appreciate that. And thank you to Abdul. Appreciate both your comments.
Now, if someone wants to get into trading, how would you suggest that they start? Is there a website that they can set up an account, or should they study some things first? How do they study the market first? How would you suggest that?
Let me just stop my share. I know website I'm working on. Well, I work for, rather. I work with, producing some content for them. Just give I'm just going to give you some. I'm going to give you some websites. I'm just getting the URLs for those websites. That's one. Right. Okay, so these are two websites which are both good for different reasons. Okay, those are two very useful resources. TradingView is very good for charts and also has educational material.
Who did you send that message to? Because I don't see it in chat yet.
You don't see it? In the meeting chat, it says at the top.
In the meeting chat? What can you see down below in the message? It says like from you to, do you see who it goes to? It should say to everyone.
Yeah, I don't see where it says. It doesn't say to everyone.
Because I don't see a message from you. It must have gone to a certain person.
Oh, group of people, because Steve Kalki,
Oh,
Ramazani, Abdul, Constance. Maybe I only went to Abdul. Okay, so how do I get rid of? Okay,
you can click on that to button and you'll see a list of everybody. And at the very top, it says everyone in meeting.
Yeah. Okay. Right. No,
That always gets me too.
That I only answered. Okay, now I got it. I'm not too.
So to kind of wrap up some ideas here, you're talking about find out how much money you have to invest. Think about how much risk you want to take per day.
Yeah.
And make sure that the volatility of the market stays within that risk.
Yeah.
Then go ahead, take the trade and watch it very carefully. And when it hits that point that you feel comfortable with, sell or buy, whether you went long or short.
There's also another aspect of learning to trade, and that is that you can practice without risking any money. And there are two ways to do that. One is with demo accounts, And another one is with backtesting. And there are online websites where you can backtest the markets with your trading plan. So you can see what's happened in the past years if your trading plan would have worked. Yeah, backtest the markets. And the other one is using a demo account. Because a demo account is live market prices. It happens as it's happening. And you can get demo accounts on TradingView. You can use a demo account on there. And Bozzolano wants to say something.
Yes, thank you, Gino.
You're welcome.
I'm just looking at this question of the Naira and the US dollar. And I know we are suffering from this currency inequality, and it's really a big challenge, but I see it beneficial to business people who actually are able to raise a lot of money. I've always thought of buying, I'm allowed to open a US bank account here in my country. And it's something I should do because my family lives in the US. But with my little money, I can't produce a lot. So, and then I'm wondering, really, that it's not, if it's really practical for maybe a large section of a population in developing countries. My currency is considered to be one of the strongest in Africa. And with our economy tied to the Republic of South Africa, South African rand goes down, we have to go down by default. So I'm just wondering if this is ideal for really big businesses to curb the risk of the ever falling currencies, which is also another complicated calculations. Like if you look at a country like Nigeria with a large population, one would think it's got so many natural resources to back up its currency and economy. But it's something I never understood in my geography classes. So that is actually a comment rather than a question. Thank you.
Yeah, no, it's a good point. And of course, I'm pretty sure that Nigerian companies, especially ones that have to import products, yeah, I'm pretty sure that they regularly sell the Naira and buy dollars, because when it comes to, maybe they have to buy the product 6 months later, and the Naira fell 10%, and it's 10% less profits for them. So I'm sure they do take action in the foreign exchange markets. Yeah, definitely. And so yeah, so I was saying when you start before you start trading, you have various things, let's say various homework you have to do, and that is basically creating your trading plan and backtesting that trading plan. You can do it on a demo account where you risk no money, and it's in a live trading environment with live prices. It's possible to do that on TradingView. Or you can buy some backtesting software and backtest your trading plan over various years and see how it held out. But I often found that backtesting my plan worked, and then when I went into trading, often it wouldn't work. And the reason why it wouldn't work, I discovered at my expense, was the lack of discipline. You have to have a lot of discipline in maintaining your plan, because if you back tested it and it worked, it means it's most likely to work going forward. And if it's not working, the most likely reason is that you're not being how do you say, disciplined, and you're not taking you're not taking correct risk management, and you're not trading the markets. You're trying to gamble the markets. And that's a big concept that a lot of people don't understand. Trading is not gambling. Yeah, it's a very disciplined activity, and you definitely need to have everything in place. Right, those are above links to Nigerian gaming stock exchanges, right? Okay, yeah, yeah, that would be for shares and relative to shares, yeah. But if you want to change, if you want to trade forex or indices of international stock exchanges, and you probably need a broker rather than, even if you want to trade stocks from Nigeria, you still need a broker. Those are the stock exchanges, yeah. So, yeah.
Gino, what do you think about just investing into mutual funds and then just, taking some of that thinking out of it? What do you think?
Yeah, those are always good options, and mutual funds or exchange traded funds that simply follow the strategy of buy and hold, meaning they buy a set of stocks, might be Standard & Poor's 500 or Dow Jones 30, or I'm sure in African exchanges as well. There are probably ETFs that buy a variety, a basket of stocks, because obviously it eliminates the need to actually try and time the market and buy the right stocks. Because when you buy the broad stock market, you're getting a piece of every stock in the market, and when the stock market as a broad asset class goes up, you get your benefit. And like I was saying before, you're not picking a winning horse, but you're picking a bunch of winning horses. They'll all get to the finish line, and you don't risk picking a horse that doesn't even make it to the finish line.
So does that make like a conservative investment to protect oneself if their currency is going down?
Yeah, you can, but if you're looking for currency protection, the only way is to use the foreign exchange market. And that would be only to sell Naira and buy US dollars or euros. If you
go into a mutual fund that's traded in US dollars, that happens automatically, doesn't it?
That's a good way, yeah, of course, I missed the point, yes. Yeah, if you buy mutual funds or ETF or exchange traded funds, ETFs in dollars, denominated in dollars, then yeah, that's perfect, because you sold the Naira to buy the dollars, to buy the shares of that fund, and your risk is in dollars. So when the Naira goes down, you're actually making money, you're not losing money. Yeah, that works.
All right, we got a question here from Steve Kalpi. Go ahead, Steve.
Good morning, everyone. Gino, excellent presentation.
Thank you very much.
So my question is, from where I sit, we are invited to invest in Bitcoins. How can you guide us?
Well, I'm going to share my screen again, and we'll just get a bit of familiarity with Bitcoin.
Bitcoin is a very important topic to discuss, isn't it?
It's a very important topic, and my view, I'll just give my view personally on this, right? This Bitcoin is a great asset class, and simply for one fact, it's decentralized. There's no Federal Reserve, there's no European Central Bank, there's no Bank of England, there's no Central Bank of Nigeria. There's nothing and no one that can influence or drive the price of this asset one way or the other. This asset simply reacts to what the market believes the price of this asset should be. Nothing more, nothing less. Simply supply and demand. So nobody can control this asset. And I think I do really believe Bitcoin in particular and Ethereum, the biggest two, have a lot, have a lot of future. A few months ago, I think it was 6 or 7 months ago, you'll probably find this if you look it up in Google, JP Morgan declared its favorite alternative asset as cryptocurrencies. I think specifically Bitcoin, if I'm not mistaken. Okay. The previous favorite alternative asset was real estate. Real estate is probably the most well-known alternative asset and has been for millennia. Yeah, everybody owns a house, everybody owns property, everybody understands the value of property. And JP Morgan changed their favorite alternative asset class from real estate to Bitcoin. I believe it was Bitcoin. I'm not sure if it was cryptocurrency in general. So what I just wanted to show on this chart is how wild Bitcoin has become. From its low back here, in November 22, it went flat for a while, then it started going up, now it came down, now it's still back up again. It's definitely in a bull market, as we can see on the day chart, but that bull market hasn't been confirmed. The long-term bull market isn't confirmed until we get a breakout on the weekly chart, okay? And in my honest opinion, that's just my opinion, I'm sure in the next year or two, we'll see prices up around here again. I've got no doubt about it. And but on the daily chart,
Is that around 39,000? You think it's going to be going up to around 39,000?
Yeah, that's where we're going to see.
So if someone's going to protect against, like, for example, a fall in the Naira, maybe go into Bitcoin instead of the US dollars?
Yeah, that's good too, because Bitcoin, how to explain this? If you sell the Naira to buy Bitcoin, in a derivative way, you're also long of US dollars, because Bitcoin is quoted in dollars, right? So if the excuse me, if the value of Bitcoin goes up, it goes up in dollars, and you sold the Naira and you bought Bitcoin, well, you're going to have more dollars. If then the exchange rate of Naira to dollar goes down, you've got even more Naira. Yeah. So I definitely that could be a good way to protect yourself from a fall in Naira. The only thing is I don't know what kind of adoption Bitcoin has in Nigeria at the moment. So you might want to consider it as an investment for the long term, let's say, and keep some of your portfolio in Bitcoin or Ethereum for the long run. Yeah.
Okay, we have another question coming in from Antwi Daniel. Go ahead.
Hi.
Good morning to everybody.
Good morning, Andrew.
Good morning. Good afternoon too.
Yes, good afternoon. Please, my question is, I want to know the psychological aspect in trading.
Sorry, you're breaking up. You're breaking up. I can't hear you very well.
You said the psychological aspect in trading.
The political?
The psychological aspect in trading, because when you were speaking, I heard about you said something about psychological.
Yeah.
Yes, so I want to know the psychological aspect in applying in trading.
Right. Yeah, I was saying that it depends very much what excuse me, what type of character or what type of personality you have. Because you might be the type of trader that likes to put on a lot of risk for a very small percentage amount, increase or decrease in the trade. Yeah. And then you close your trade either with a percentage amount that's very small, even though it actually represents a lot of dollars. Yeah, because if you're using a very high amount of leverage, a small percentage increase in price means a big amount in dollars. Yeah, does that make sense?
Yes,
if I'm using 50-to-1 leverage, yeah, and I have $10,000 and I'm using 50-to-1 leverage, I can trade with $500,000. Yeah. So if it changes, the price changes 1%, yeah, that's $5,000. So maybe I only need the price to change 0.5%, because that's $2,500. And with a 0.5% change in price, I'm happy, and I get out of my trade. Yeah, this is the difference in personality, really, because some traders don't want to see the trade for a long time and wait on a trade and watch it go up and down until eventually it goes up and they can make money. Some traders want to see a very small trade, a very small time horizon, yeah, 5, 10 minutes, 20 minutes, with a very small percentage, and then they take their profit because they have used a lot of leverage. And others prefer using less leverage, yeah, maybe 5-to-1 or 10-to-1. They put on a smaller trade, they wait longer, maybe they wait hours or days until the trade, you know, evolves, eventually it goes in their favor, and then they take a profit. Right, Steve, Calpi. Okay, does that answer the, yeah? Okay.
Thank you.
Right. Steve Calpi. Steve Calpi is asking, what are the steps to start a Bitcoin investment account? To start a Bitcoin investment account, you need to go to one of the online exchanges. As you're in Nigeria, I don't know what the law requirements are specifically, but you should check the most famous exchanges, which are Binance, Coinbase. There's some others I can't think of right now. Binance, Coinbase. I use Coinbase. Very easy to use, very easy to open up. And they're very stable. No risk of them going bankrupt for now, at least. But I don't know. So you go on their website, you fill up the data that they ask you for, and eventually they'll open you an account. It takes a day or two. They open your account and you can, oh, you're in the US. Okay, well, Steve, if you're in the US, probably Binance or Coinbase are probably your two one of the two best options. And it's really easy, just follow the instructions online. You have to give them some documentation like your ID card or some kind of ID, you know, some kind of invoice to sort of satisfy their needs to know where you live and all this kind of stuff. And then once your account's open, you can make a transfer of dollars into the account. Once a transfer has been made and the dollars are in your account on the exchange, and you just go in and buy whatever cryptocurrencies you want. Both exchanges have a lot of cryptocurrencies, and apart from Bitcoin or Ethereum or Ripple and so on. I hope that answered your question, Steve. Right, well, it's 5:30. I guess we can, I don't know, if there are any more questions, anybody have any other questions?
I don't see any more. I think we can leave it there.
Yeah, okay.
And when you come back to talk, what subject would you like to talk about?
Well, I think I would like to talk about a bit more about trading plans and how to implement a trading plan. I'll have a bit more detail, go into that with more detail, let's say, because we mentioned it, and I sort of mentioned a couple of topics, but I'd like to get into more detail on how to actually create a trading plan. So you're not just going in, you know, oh, let's just give this a go and jumping in the deep end of a swimming pool when you don't know how to swim. You have to learn how to swim, you know, a step at a time, and just give yourself more chances, basically.
I think this class was great because we have some links that the students can look at and start exploring, even some demo accounts they can play with, get some of the terminology, look at the graphs, look at some of those technical barriers like the cloud, and just to get into it and get a feel for it. And then I think that's a good base to continue growing with the knowledge.
Yeah, indeed. Yeah, so I think that sort of fits the next class could be trading plan and how to create one. Yeah.
Perfect.
Yeah.
Well, Gino D Alessio, thank you so much
Thank
for
you.
a
Dr.
very
Smith.
complicated, deep subject. And I know it's hard to simplify it down for
It's
an
hard. There's a
introduction.
lot of information. It
And,
is.
and working the math, trying to
Yeah.
explain the math, the margins and everything. It takes a while to look at it, feel it, and understand it.
Indeed,
But
yeah.
But the first step is you have to look at the formulas and talk about them, and then you start to understand.
That's right. Yeah.
So
Okay, yeah,
thank you
we'll go
so
over
much. We look forward to having you back.
Okay, thank you very much,
Into this
everyone. Been a
very
pleasure.
important subject.
Thank you. Been a pleasure. Take care, everyone.
I'm going to open up everybody so that they can unmute themselves and say thank you and bye to you.
Okay.
Thank you.
Thank you, guys.
Thank you, Gino.
Thank you.
Excellent.
very much.
Thank you.
Thank you.
Thank you. Thank you so much.